This meeting is being recorded.
Good afternoon, ladies and gentlemen. Welcome to IIFL Wealth and Asset Management's Q4 FY22 earnings call. All participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the management shares their thoughts. Should you require assistance during the conference, please signal the host by tapping on the raise hand icon. Please note that this conference is being recorded. We have with us today Mr. Karan Bhagat, the Managing Director and CEO, Mr. Anshuman Maheshwari, the Chief Operating Officer, Mr. Sanjay Wadhwa, Chief Financial Officer, and Mr. Pawan Mangnani, Head Strategy and Investor Relations. I now hand over to Mr. Sanjay Wadhwa to walk us through the results.
Thank you, Anil, and a very good afternoon to everyone on the call today. The financial markets have witnessed lots of ups and downs during the last financial year. Amidst all of that, we are happy to report another exciting quarter. We have steadily grown quarter on quarter through the last financial year across all the key metrics in the form of growth in AUMs, net flows, revenue, steady retentions, and profitability. Let me start with a brief overview on the financial performance of the company for the quarter and full year ended March 31st, 2022. Starting with assets under management, our total AUMs are now more than 327,000 crores, up 33% over FY21 levels. Excluding custody, our overall AUM have increased 26% year-on-year to 261,000 crores, with wealth management AUM at 207,000 crores and asset management AUM at over 55,500 crores. Importantly, our ARR assets increased 4% quarter-on-quarter and over 42% year-on-year to 144,000 crores. With this, the share of ARR assets in total AUM now stands at almost 55% as we continue our journey towards steadily increasing the pie of ARR assets. Happy to share that our net flows have also been relatively strong, both for the quarter and the full year. We clocked 7,000 odd crores for the quarter and more than 31,400 crores for the full year. Our loan book has also increased 19% over FY21 levels to 4,318 crores. Now coming to revenues and retentions, our total revenues increased 7% quarter-on-quarter and 57% year-on-year to 449 crores. As compared to FY21, we were up 46%. Our revenue from operations were up 12% quarter-on-quarter and 59% year-on-year to 423 crores. Importantly, our recurring revenues have increased 3% QOQ and 57% YOY at 252 crores. Our FY22 numbers are at 912 crores, up 56% over FY21. Further, the growth in ARR revenues has come from both wealth as well as asset management business, both seeing a very healthy uptick over the last quarter. This quarter has also seen strong transactional revenues at 170 crores, up 28% quarter-on-quarter and 63% YOY, reflecting the market opportunities. Total retentions have held strong, increasing by 5 basis points to 63 basis points over last quarter and 7 basis points overall for FY22 over FY21. Most importantly, retentions on ARR assets have also been steady with a slight increase to 74 basis points. Now coming to expenses, our total expenses for the quarter increased 6% quarter-on-quarter to 235 crores. Of this, total employee costs increased by 4%, while admin and other expenses were up 11% over last quarter. On the overall FY22 numbers, we see costs up 38% from FY21 levels, with full year cost to income at 51%. As per guidance provided last quarter, we expect annual costs to remain steady for FY23, with full year cost to income ratio improving to about 45%. And now coming to profitability, operating profits before taxes increased 21% quarter-on-quarter and 66% over last year to 188 crores and 614 crores for FY22. We achieved highest ever quarterly PAT at 168 crores, an increase of 8% over last quarter and 64% YOY, and 58% from FY21 levels. Importantly, our tangible return on equity, which is return on equity excluding goodwills and intangibles, has increased to 28% for the quarter. For the full year FY22, our tangible ROE stands at 25%, up from 15% levels in FY21. We are on course to further improve profitability and capital efficiency as committed earlier. In the current financial year, which is FY23, we expect to see further improvement in all the key financial parameters, mainly in contribution of ARR revenues to total revenues, and bringing in better operating efficiencies, thereby improving the cost to income ratios. The internal restructurings which are currently underway on the asset management side as well as the distribution front are expected to improve operating efficiencies. With that, we come to the end of the financial highlights. I'll hand it over to Anshuman to cover key business and strategic highlights.
Thanks, Sanjay. Good afternoon, everyone. The last few months have been dominated by geopolitical events and macro environment changes, specifically given high inflation and increasing interest rates. While there are questions on the near-term outlook and higher volatility across asset classes, we remain confident on the medium to long term. It is specifically in these uncertain times that we wanted to re-emphasize on the three core tenets of our strategy: growth, resilience, and agility. The impact of these are increasingly visible through our business performance that Sanjay just spoke about, and we continue to work hard on each of these every day. As you would have seen, we have also provided a detailed strategy update section in the investor presentation. Speaking through the three tenets in a little more detail, the first strategic tenet is growth. We are in the fortunate position of being a part of one of the greatest wealth creation cycles this country has seen, one that we expect will continue for the foreseeable future. Ultra HNI and HNI wealth continues to grow at an unprecedented pace, and the market size therefore continues to grow exponentially for us. Further, a large part of this new wealth creation is happening in tier 2 and tier 3 cities, where access to high quality advice is usually not available. Given the strength of our platform, our people, our expanding geographical spread, and our understanding of the requirements of our core client segment, we are well positioned to capture a larger share of this new wealth creation. With significant focus on digital, we are also well placed to extend our unique wealth management proposition to newer client segments. On the alternate asset side, the Indian market is still nascent, and if developed countries are any indicator, then we have huge headspace for growth. Worldwide alternate assets continue to attract the lion's share of revenues, almost 46% of asset management revenues, even though it accounts for only 15% of AUM. With our diversified strategies on the alternate side, our platform and leadership position in this space, we again see significant opportunity for growth through the various macroeconomic cycles. The second strategic tenet is resilience. We have worked hard over the last few years to make our business increasingly resilient to a variety of shocks, market-driven or event-based. And this continues to be a key focus area for us. Specifically, we have successfully transitioned a large part of our AUM and revenues to the recurring fee model. We have spoken extensively about this transition over the last few quarters, so I'm not getting into further detail on this today. But we just want to highlight, as we had shared earlier, we are close to the end of this transition and a steady state model going forward. In addition, assets under management for our wealth clients remains well balanced across equity, which is at about 54%, and debt at 46%, providing for significant resilience to market movements. In addition, our leadership position across multiple alternate strategies provides for a natural diversification. Continuing on resilience, most importantly, our client and employee base continues to see high retentions. 42% of our clients have been with us for over 5 years, highlighting the balance between onboarding new clients each year while ensuring high continuity on existing ones. For the year, our client attrition, both in numbers and AUM, remains very low at approximately 2% and 1% respectively. On the other side, this has been enabled by high continuity of our senior relationship managers. 78% of our team leaders have been with the company for over 5 years. Not only does this drive client continuity, but it also allows for significant improvement in productivity and AUMs. The third, and again a critical tenet of our strategic pillars, is agility. We have historically as a business been at the forefront of product innovation, structuring products for our clients across various market cycles, both up and down. Our full service platform, including wealth and alternates asset management, ensures that our clients are constantly engaged with us. A variety of engagement types also ensures that we are able to serve the differentiated needs of each client effectively. We are constantly upgrading our digital and technology platform to better serve the needs of our clients, with the aim to make transactions seamless and enhancing productivity across the entire spectrum of the organization. Overall, these levers put us in a position where we believe we are best placed to grow and create value for all our stakeholders and provide the best outcome for our clients, employees, and investors alike. With that, I would like to hand over to Karan and open the session for Q&A.
Thank you, Mr. Anshuman Maheshwari. We will now have the Q&A session. May I remind you, please tap on the raise hand icon in case you wish to ask a question. Kindly introduce yourself and the name of your firm before you ask your question. We'll just give it a minute before the question line assembles. First on the line, we have Mr. Mohit Mangal. Kindly unmute yourself, introduce your firm and ask your question.
Yeah, hi. Thanks for the opportunity. Mohit here from Bank of Baroda Capital. So my first question is in terms of the non-recurring revenue. So we saw a huge a jump to 170 crores, which is not usual. So can you just explain as to what the deals for this and what was the quantum?
Thanks, Mohit, for the question. So I think quarter 2, quarter 3, quarter 4, in some senses last year, have seen a fairly large jump on the transactional income side. Some of these transactions are also included as largely some of the transactions are one-off transactions which may or may not get repeated. But we had the sight of these transactions through quarter 3 and quarter 4. Some of them are transactions on the unlisted side. Some transactions include some placements on National Stock Exchange. And therefore, we had the ability to balance and expedite the cost transition for the next 2 quarters in the third and the fourth quarter. So some of the transaction income broadly around about, give or take, 80 to 100 crores per quarter stays constant. The incremental amount for last quarter is something which is largely a function of the way the capital markets have been for the last 9 to 12 months. And being conscious of that, we've kind of, in our projections for the next year, factored in around about the constant number of 80 to 100 crores as transaction income.
Perfect. Now the second question, is on IIFL1. So we saw positive net flows of around 1500 crores, this quarter, which was the highest in the last 4 quarters. So should we assume that, the clients have started taking interest in this product and we see this upturn going forward?
Mohit, I continue to be very positive on IIFL1. I think a slightly tepid market environment will actually spur the growth of IIFL1 even more. I think generally speaking, in very, very active capital markets, clients are slightly bit more focused on transactions. In slightly more flattish markets or slightly more challenging markets, clients and relationship managers and the firm focuses on the platform as much, if not more, than on transactions. So I'm quite positive in the year we see coming by. Generally speaking, IIFL1 will see much more growth, and therefore transaction incomes with a little bit of the muting on the transaction income will be more than offset by the increase in IIFL1.
Perfect. My last question is on custody assets. So we saw, custody assets growing from around, say, 39,000 to 65,000 crores this year. So is there any plan in which you can monetize or, take benefit out of it? Because now at present we are not getting anything from custody assets.
So custody assets are, really in some senses promoter stock lying in the demat account, right? So some of these are strategic in nature because some of these include unlisted stocks. Therefore, at some point or the other, when they get monetized or the IPO comes, in some way having custody of these stocks gives us the first sight. So I won't say it is of no advantage or no use. In the long term of 3 to 5 to 7 years, more often than not, they either lead to some kind of monetization, either through dividends or through sale. But and therefore the ability to have that obviously allows you to have the first sight. But on the immediate basis of next 3 to 6, 9 months, obviously monetization on the pure custody assets is difficult.
Perfect. That's it from my side, and all the best.
Thank you, Mohit.
Thank you. May I remind you, please tap on the raise hand icon in case you wish to ask a question. Next on line, we have Sarthak Shah. Sarthak, kindly introduce your firm and ask your question.
Hi, I'm Sarthak Shah from Prabhudas Lilladher. And you had mentioned restructuring on the asset management side of the business. What impact would this have on the margins in the coming year?
Sorry, can you just repeat the question?
Yeah. You had said that you all are doing some restructuring on the asset management side of the business.
No, honestly, I think from a restructuring perspective, it's just maybe a combination of the alternate assets and the mutual fund being in two separate entities. It has no impact on the business itself. We have in fact kind of expanded our investment team on the alternate side. We've got a team led by Akash, which has joined us on the fixed income side, complementing our team on the listed, unlisted, long short, as well as on the real estate side. So I think from a strategy perspective, for us, credit over the next 12 months will be a good fuel for growth in a similar way where listed and unlisted equity assets have got added over the last 1 year. The restructuring is only limited to really an entity reorganization. It has really no impact on the business itself.
Okay, all right. Thank you. That's all I have.
Thank you. Next in line, we have Aejas Lakani. Aejas, kindly unmute yourself and ask your question.
Hi, Karan. Congratulations on the result. This is Aejas Lakani from Unifi Capital. So, Karan, a couple of questions. The first is that, in the guidance that you have called out for the coming year, the employee costs are down to 33%, which we closed this year at 39%. And that has the fixed and the variable component. So could you just speak a little bit about how this line item will impact?
Yeah, so I think that's a good point. I think, I kind of explained it a bit last quarter, but I'll do it again. So I think even in this year, honestly, the current year cost on the normalized basis would be in the region of 33-34%, somewhere in the region of 32-34%. So broadly on, if you look at the costs, it would be largely around about 75 to 80 crores of fixed salary costs on a quarter-on-quarter basis, and another 150 to 170 crores of variable cost. So broadly on a revenue stream of 1500 odd crores, it would be in the region of 450 to 500 crores. The current cost, which is being reflected over the last 4 quarters, effectively includes a one-time cost, which we've kind of run for the last 2 years, and would have extended for the next 6 months in the next financial year, largely on account of the revenue transition from upfront to tail. So on the last 30 odd months, we've continued to pay our relationship managers on an upfront basis, whereas the firm is largely booking the revenue on trail. So in some senses, for the last 2 years, we've had around about a 75 to 100 crore incremental employee cost, which effectively stops from April of this year. So it would have, in normal circumstances, continued as we had guided to September of 22. But we've kind of given the velocity of transaction income over the last 2 quarters, we were able to digest the next 2 quarters incremental salary cost in the last 2 quarters itself. So effectively from next year onwards, next financial year onwards, we are back to status quo. With our fixed cost being in the region of 75 to 80 to 85 crores a quarter, which is around about 340, 350 crores, and the remaining 150 crores largely being the variable cost, representing around about 32 to 34% of our guided income.
Got it. And this variable payout goes to the team leaders and the RMs that support the team leaders, right?
So it's across the board. Largely, if you see, it's in three big buckets, right? So the first bucket really, as you pointed out, is on the wealth side of the business, which in turn is kind of broken up into four parts. Is the wealth relationship managers and the sales team and the investment advisory team and the product team, all four of which are front facing with the clients. We then have large pillars supporting the wealth business on the NBFC side and the trust side, which also kind of chip in. Then you've obviously got the investment team on the asset management side of the business, and you've got a small sales team on the asset management side, and then you have the corporate functions, which are largely 9 or 10 in broad nature, starting from let's say the finance function all the way to legal compliance and so on and so forth. So if you really see from an employee pool perspective, it's largely a sum total of these three big heads.
Got it. That's helpful. And just on the cost side, you mentioned, I think, last fall that, you'll be investing in digital and a few other expenses. So this quarter we had admin and other expenses of about 57 crores. So is that the new run rate that we should be sort of thinking? Because this number has been closer to 35-40 crores earlier. So is that the... Yeah.
No, so I think that's not the new normal. I think the new normal is around the 50 crore number as we've kind of guided. Broadly, the 50 crore includes an incremental 4 to 5 crores, largely a quarter coming out of the digital spend. I think we are at a steady 40-45 crores for the rest of the admin expenses. What we've ended up doing in the last quarter is obviously we've got a lot of accumulated employee benefit, in the sense employee training programs, a little bit of client entertainment programs, largely in a sense with the direct marketing efforts over the last 2 quarters, given the accumulated non-engagement over the last 2.5 years. We pushed that out a bit over the last 2 quarters, which has led to the incremental 5 to 7 crores quarter, last 2 quarters, marketing and admin costs being extra, but we don't see that repeating itself. We see our regular admin cost being in the region of 40 to 45 crores and a further 5 to 7 crores coming on account of digital.
Got it. And sort of going into next year, what would be some of the areas that would give you some worries in terms of if any?
So I think from a worry perspective, obviously, I think the three things in our business, and it's not only next year, I think it's in every year, to be fair. I think first, obviously, I think from a market perspective, obviously, though the business is phenomenally resilient in a way where we've been able to get 70 to 80% of our revenues as ARR. Yet, having said that, obviously there is a slight mark-to-market impact in case of very choppy markets as we head into the next year. Last quarter, obviously, we've had a 3 to 4% maybe mark-to-market negative on the AUM, but that's been more than offset by the net flows. So obviously, I think going into next year, where mark-to-market might be a bit choppy, we'll have to ensure that net flows continue to be adequate, to ensure that if there are any surprises on the mark-to-market side, that can be well balanced. On the second side, obviously, extreme movements in the market can make markets a little bit fluttery, and therefore, transactional income can become a little bit more difficult than normal. And even though it's 20%, it can cause a little bit of pluses and minuses in case of extreme market situations. I think broad market conditions with plus minus 10-15% of the market is very well tolerated by a firm like us, purely on account of the diversification of our asset classes. Even today, we would be 50-50 broadly in fixed income and equity across all our businesses. So a little bit of movement in markets really doesn't impact client sentiment in that way, but absolute big volatility can have a little bit of impact. And third continues to be talent. So I think while we continue to attract a lot of talent into the firm, it's pretty much order of the day that 1 out of 25, 30 or 1 out of 40 people would also kind of move out. So I think the continuous balancing act of attracting new talent and balancing it with let's say some people who move on is something which is a continuous challenge. So I would honestly put these three, and obviously all these three things are not binary. There's a thin line. There is no 1-0 situation in all of these three things. And really, it's a function of our ability to kind of handle these three in a particular way if extreme things happen, to ensure that the quality of the business keeps us going.
Or if that's helpful. And just one last one is that, you've spoken about mid-market expansion, where you're now targeting a different client base, which is between the 5 to 15 crore category. Is that behavior any different from the existing client base? What is the nature of these clients, and are you able to push them a different kind of a platform or product? You could expand a little bit on that.
That's a great question. I think, we've been kind of thinking through that idea over the last couple of years, and I think we've reached a place where we're sure we want to get into it. I think it's really difficult to define it as 15 or 20, but I think in our minds we are clear that outside the top 3-4 cities, we are broadly looking at, let's say, the 5 to 20 crore market as let's say the second segment we want to attack, and the top cities are broadly the 10 to 25 crore market. These from a behavior perspective, I think these clients behave fairly similarly to the ultra HNI clients. So from a product behavior perspective, there's a huge amount of match. From a delivery perspective is where we need to make some changes. Obviously in the ultra high net worth category, it's a phenomenally high touch model, and therefore from a cost perspective, even having a cost to serve ratio of somewhere between the 25-30 clients works. But on the 5 to 20 and the 10 to 25, we'll have to push the cost to serve to around about 45-50 clients. And that's really where we're investing a lot of our time on ensuring that we are building the right digital tools, and we are in a position to kind of go live to market in the first quarter of next year. So from a proposition perspective, I think it will lead us to do two things. It will allow us to expand a bit in the mid-market as we launch, but it will also need us to make our proposition on the ultra HNI space much sharper. When I say much sharper, I think we'll be able to make it substantially more focused and maybe get a better platform out to our clients who are more than 25 crores with us. So I think it's an ongoing exercise. We are fairly excited with it. We've got our we believe we need like we have 11-12 blocks on the ultra high net worth side from a platform perspective to succeed. We need similar 11-12 blocks on the mid-market side to succeed, and we are in the process of building out those 11-12 blocks as we speak. And from a timeline perspective, either first quarter calendar year next year or first quarter financial year next year is really when we should be able to position ourselves for that launch.
Oh, that's very helpful. Just one last thing again. You out of 31,000 crores that you raised, roughly 1/3 was in the asset management bucket and 2/3 on wealth. You see a similar kind of proportion for 23?
Yes, I think that's the right proportion. I think, obviously 60-40, 65-35, 70-30, that's broadly the proportion it's going to be in.
Got it. Thanks a ton. All the best.
Thank you.
Thank you. May I remind you, please tap on the raise hand icon in case you wish to ask any question. Next online, we have Shivani Mittal. Kindly unmute yourself and introduce your firm. Thank you.
Hello. Hi sir. This is Shivani Mittal from Dalmia Securities Private Limited. I had just one question. I believe we have removed the guidance slide in the current quarter. So just wanted to ask if the guidance as of quarter 3 still holds in terms of all parameters, because I think we have been giving guidance for many quarters right now.
No, Shivani, I think we've typically given guidance at the end of quarter 3. And if there is any change, then we update it. Otherwise, the guidance stands.
Okay. Yeah. Thank you so much, sir. That's all.
May I remind you to please tap on the hand raise icon. We'll just give it a minute for more questions. Next in line, we have Ashish. Kindly unmute yourself and introduce yourself and your firm. Thank you.
Sorry. Hi, Karan. Just a quick data question. How much is the performance fee income that we have booked in this quarter? And what is the accrued number that we are carrying on private equity funds?
Ashish, there is practically zero performance fee booked in the last quarter. Most of the performance fees is carried forward. We've got our first fund, which we raised in 2016, maturing in the current financial year. So that will become carryable from the first quarter of the current year. From an estimation perspective, I think just on a mark-to-market basis across all our private equity funds put together, the performance fee would be around somewhere in the region of 350 to 400 crores across all our funds. But that number itself is fairly, if I can put it this way, fairly closely linked to the movement in the markets. So the movement of that from 350, 400 to 500 back to 300 is fairly fast. So more often than not, we don't end up calculating it on a quarterly basis. But having said that, the last we did it approximately a couple of months back, it's in that region of 350 to 450 crores, which we are carrying into this year.
And I presume that's not built into your guidance that you're giving for next year.
Not really. Not really.
Okay. Thanks. Thanks a lot. Wish you all the best.
Thank you.
Thank you. Thank you. Next in line, we have Subrata Sarkar. Kindly unmute yourself, introduce your firm and ask your question.
Hi, this is Subroto Sarkar from Mount Intra Finance. So I have two questions. First, on the strategy, from a strategy level, Karan, are we thinking of there are a lot of financial institutions and banks who don't have as such strong wealth management network. So are we thinking of officially doing some tie-up with them so that we can have mutual relationship with them? So it's on a broader strategic aspect, but any thought on that?
No, so I think, thanks for that question. So I think I'd like to answer that in two parts. I think we would love to do tie-ups with banks on the asset management side, and I think the team's been working hard. And today, it's fair to say that maybe 60 to 65% of the banks we've tied up for our asset management products. I think that's the path of least conflict and ensures us to be able to kind of give out all our innovative products from the asset management side to the banks. On the wealth management side, I think I believe unless and until we have a strong tool on the mid-market side, on the ultra high net worth side, we would not really want to approach our clients through an intermediary. We would like to approach our ultra high net worth clients directly, because if we approach them through an intermediary, we would need to pretty much give up those clients for our entire lives and share a large portion with the intermediary. We believe we have the product strength and platform to be able to reach out to most of the ultra high net worth clients over the next 5 to 10 years ourselves. So on the ultra high net worth side, I think our current strategy remains more B2C, where we would like to engage with clients directly. On the mutual fund side and the alternate asset management side is where we would like to really strengthen and deepen our relationships with all partners and banks to see how we can reach out to their clients.
Okay. Now, since you maintain on the mid segment basically, so there are few companies which are aggressively getting into they are into mid segment basically, including one of the listed players. So what I mean to say, Karan, how serious, on a strategic point of view, what is our view? First, number one, are we serious about the mid market segment because it requires a different tech platform, it requires a low touch, more kind of a digital platform and all those things. So number one, are we serious? Does it make sense for us? Because strategy will be a little bit different for us. So, and do we foresee that segment to be a very big segment in next 10 years, let's say?
The answer to the last part of the question is yes. I think the segment is growing disproportionately in size, especially the 5 to 20 and 10 to 25 crore segment. I think as newer companies are getting listed, the number of individuals, employees in every MNC, large domestic Indian company, as well as the new companies which are getting listed, having a financial net worth of 5 to 20 crores to invest is becoming disproportionately larger and larger. So from a size of the market perspective, there's no question about it. From a capability and a cost to serve ratio perspective, I agree with you fully. I think the biggest advantage and commonality we have is our commercial understanding of what the client would want and our product expertise. On the flip side, what we need to build out extremely well, as you rightly said, is a technology stack which allows us to give a phygital experience to the client. Do remember, we are not focusing on the 1 lakh to 1 crore client, which is going to be a very, very different transaction brokerage-led experience, which we are not really looking to do. We are still, when we are talking about the 5 to 20 or the 10 to 25 crore segment, pretty much for most banks and most other players, that would be really the private wealth segment in that sense. So we are really not going down to the retail or the mass affluent segment, which I think would require a very different approach. In our case, I think it's a phygital approach. Somewhere, it requires a better technology stack for sure, but it also equally requires a strong platform and good product expertise. So I think we have a right to win there. The size of the market is very large. At the same point of time, are we ready to implement it today? From a platform perspective, the answer is no. Are we investing some of our time and resources to build the platform? The answer is yes.
Last question from a market business perspective, Karan, just we have seen unprecedented new account opening in last 2-3 years, and a significant part of that they want to trade of their own without help of let's put it like this, it's a discount brokerage led upside. So now only thing what I'm trying to understand, once this market settle a little bit, making easy money doesn't become so easy to make money from this market directly without a help. In that circumstances, are we envisaging that a lot of these clients will gradually move to a wealth management platform like us, or let's say to the mid segment also? So from a market perspective, is that a better will be a sweet point for us? Like already a lot of client exposed to equity and investing, but they will struggle at some point of time when market will not give that kind of a disproportionate return.
I think it's a really tough one to foresee as such, but from my thought process, I think there will be a place for all three kinds of clients in the market. There will be always a set of clients who are always operating on a DIY basis, do-it-yourself basis, who will have the inclination, passion, and the time to do it themselves. There will be a second segment of clients who want to be knowledgeable, who want to engage and be responsible for the decision they are making. They don't want to do it themselves. They want to engage, discuss, but obviously have the right to say yes. And there's always a third set of clients who will look at solutions in either a discretionary format or a package format, where once they've decided on a broad headline, goal, they would ideally like to kind of come into more a discretionary package kind of solution. So I think across all segments, and this I think will remain true whether the client's an ultra high net worth client or a mid market client. It really doesn't matter. I think from a client behavior perspective, there will always be three segments. Last 2-3 years, just given the way the capital markets have behaved, you rightly pointed out, I think there might be a disproportionate number of people in the first category. But over a period of time, you'll have see a kind of an equal split between all three.
Thanks a lot.
Thank you. Next in line, we have Ritika Dua. Kindly unmute yourself and introduce your firm. Ritika, are you online? Could you unmute yourself and ask your question? Yeah.
Yeah, sure. My apologies. My questions have been answered. Thank you.
Thank you. In case you wish to ask a question, kindly tap on the raise hand icon. Mohit, kindly unmute yourself and ask your question. Mohit Mangal, I think you have another question.
Yeah. So just one question. I wanted your views on the growth opportunities or the potential of the wealth management industry, and how does our company intends to, exploit this opportunities vis-a-vis the competition?
Sorry, for some reason I couldn't hear you. Growth
Opportunities or potential of the wealth management industry, and how does IIFL Wealth intends to do vis-a-vis the competition? What are the strategies per se?
No, so I think growth is a very is I guess the most important word in our industry, right? Because from a wealth management perspective, from an India perspective, we are sitting at the cusp of phenomenal amount of growth. So if you just take the question backwards for a minute, I think the stock of wealth in India obviously is growing at maybe 1.5 to 2 times the GDP growth rate, right? So the GDP is growing at 7.5%, 8%. You've got the stock of wealth growing at somewhere between the 10 to 12%. The stock of wealth again is disproportionately growing for the high net worth individuals and the ultra high net worth individuals. So there's a disproportionate growth happening there. Between that, today, nearly 55% of the assets is still in non-financial assets. 45% is in financial assets. That itself will again change. You will see nearly 65-70% of the assets over the longer term move towards financial assets as compared to non-financial assets. So if you just see the first 3 legs itself, the stock of wealth, the growth of wealth for high net worth individuals and ultra high net worth individuals, and the growth between financial assets and non-financial assets. You just put these 3 things together, it points at a fairly heady number of growth in terms of size of market for the industry itself. Out of this, obviously, then there is a certain amount of money which is managed professionally, certain portion of money where clients continue to invest in fixed deposits and so on and so forth. We believe that money is less than 20% of it is managed professionally today. That itself is going to cause that itself will be a fairly large change. And post that, obviously, comes our market share, which we kind of hope to improve. So if you look at the business itself, I think the growth levers are across the space. All these 5-6 things are massive growth levers in the business. And both on the wealth management side and the alternate asset management side, I think for the next 10 to 15 years, I think really it's a battle for us to lose, because the size of the market is really going to grow. And as long as we can keep our head straight and not make too many mistakes, I think we'll be an active participant of the growth in this industry.
Perfect. That's it from my side. Thank you.
May I request Preeti, kindly unmute yourself and ask your question. Please introduce your firm. Requesting Preeti RS.
Yes, I just got that pop-up right now. Thanks, Karan. This is Preeti from UTI Asset Management. So my question is more topical. So we have seen a merger happening in the banking industry, Citi going out of India, and they do have a large wealth business. I think 50,000 crore is something specifically to Citi Private, and there's another 50,000 crore, so total of 1 trillion. So is that client pool something of our interest, or is that a target segment? And are there conversations happening from the Citi wealth clients?
No, absolutely. I think Citi has historically got a phenomenal business on the wealth management side. I think they've been operating at all segments of the business. The Citi Select, Citi Private Client, as well as the Citi Private Bank. They built a very strong franchise across all 3 segments. Obviously, we've been in some ways lucky to recruit people from Citi all the way back from 2012 to 13, and some of them have really been successful in our platform and have led us to an ample period of growth. So from a Citi perspective, I think there are obviously 2 sides of the business. One is the platform, and second is the people. From our perspective, obviously, we would love to see if we can attract some people as we go along. I think with that, we should be able to complement our platform along with the people and potentially look at expanding in that market base. Having said that, I think banks obviously including Axis, ICICI, HDFC, so on and so forth, are also working hard to improve their wealth management proposition. So we'll have to kind of keep that in mind while we try and increase our market share.
Okay, so there was one feedback that we got in some surveys that Citi wealth client, they look at it as a holistic one, so the whole banking plus wealth management effort. So how do, if at all it comes to that, so how do you address that kind of problem?
So I think that's a fair question. I think the entire banking holistic platform comes with a little bit of plus and minus. I think some clients would like to look at that as a total solution. On the flip side, a relationship manager on the bank, more often than not, his balance scorecard becomes equally split between banking products and wealth management. So sometimes it also leads to a slightly diluted proposition for the client. So while there are certain set of benefits of being able to give a full service platform, sometimes there are also certain set of challenges and paradoxes which kind of come in while servicing a wealth management client from a banking perspective. From our perspective, obviously we work closely with 2 or 3 banks where clients open their bank accounts, and we are able to the best of our ability and the best of our tie-ups, at least from an investment perspective and immediate needs, be able to service 70 to 80% of the clients' banking needs. So I think it will be a mix of both. We'll have to manage both. We'll have to be able to do at least a large part of this minimum banking proposition, which is required from an investment perspective, and ensure that we are able to benefit from not having the same paradoxes from a balanced scorecard perspective, which a normal priority banker would face.
Got it. So just last question on this. This is very the softer aspect of it, that most of this clients want their wealth to be managed by foreign outfits. I think historically that was one of the aspects. We have seen massive consolidation happening on the domestic front. So because there is a change right now, do you think that mindset is changing? I think we got this in the survey, so if it's not Citi, probably I'll go to TVS.
I'm not sure about that survey, but I've been managing money with clients for 20 years. I've never heard a client tell me that I prefer my money managed with a foreign outfit as such. I honestly don't think it's between a foreign and domestic. A foreign outfit could do equally well, a domestic outfit could do equally well. It's a function of getting a people, platform and processes together. I think after that, it really doesn't matter whether you're a domestic bank or a foreign bank. It's all about getting all those 3 things together. And I think if you have those 3 things together, you're good to go.
Great. Definitely. The numbers do suggest that I think in the last 5 to 10 years, the domestics have definitely consolidated. But, I was just trying to understand from the customer point of view, since they have to make a decision now.
Yeah, I think if a foreign bank gets a private banking platform together with all of these 3 things working in conjunction, I think they would also be able to get the same amount of market share. I honestly don't think it's about a foreign or a domestic. It's just about getting the pieces of business together.
Got it. Thanks for patiently answering.
Thank you.
Thank you. Next in line we have Sanjay Kumar. Kindly unmute and ask your question.
Hi, Karan. First question is on the numbers. So we did 7,000 crores of flows. If we were to maintain our FY23 guidance and to compensate for the MTM losses, will the current run rate be enough, or will it be kind of a linear growth towards 8,000, 9,000 crore mark, or one quarter somewhere will have a lumpy one and then we'll continue at 7,000 crore? How will this pan out, the flows?
Really difficult to predict. I wish I had an exact answer for you. But obviously we would want it to be as linear as possible. But in reality, it doesn't happen that way. But I think, I've seen some minimum and some maximums, right? So I think it's fair to say, typically you don't see quarters with less than 3,500-4,000 crores of net flows at the lowest, and you'll typically not see quarters at more than 14,000-15,000. So I think I can give a minimum maximum kind of range. I'm not sure whether I'll be able to exactly give you a linear, non-linear kind of answer. But yeah, it would be very surprising if the numbers are below 4,500 for a quarter, and very surprising if it's more than 14,000-15,000 for a quarter.
Okay, thank you. Second, on strategy, the vintage is good. We'll continue to gain wallet share from existing clients, but I wanted to understand your strategy and your funneling process for new millionaires, given that the time to become a millionaire has come down given the recent IT salaries, IPOs, and private equity money. Say when there is a liquidity event, say a promoter is exiting or there is an IPO, how do you approach or how do you identify such prospective clients? How do you onboard or generate leads for newer millionaires?
So I think newer millennials for us can be divided broadly, let's say, in 2 or 3 categories. But let me first talk a minute about our clients' children, right? So effectively, let me call them young adults in some ways, and they're kind of broken into 3 age brackets from our perspective: 13 to 18, 18 to 23, and 23 to 32. So over the last 7 to 8 years, we've kind of engaged with our clients, young adults, in a very organized way. We have a program for all 3 age groups between 13 to 18, 18 to 23, and 20 to 32. The first program is really called an Entrepreneurship Academy. The second one's a Young Leadership Program, which involves an internship at our office. And the 23 to 32 is an event called DIVE, which we have at Goa every year. So we make it a point to ensure that we are in constant touch with our new millennial young adults of our clients. In terms of the new to the firm itself, in terms of millennials, I think what we've seen, at least in terms of the younger tech monetization events, I think our ability to reach out to those set of clients has pretty much been fairly there. I think there the behavior change has not really been in terms of saying I want to do it myself, but the behavior change has been in terms of the profile of the client, in terms of how he wants to go about building his portfolio, because he has a larger number of years left to build out wealth, as opposed to let's say some of our older clients. There, I think we've been fairly adaptive and flexible to be able to enlarge and innovate on our product platforms so as to be able to adapt to these newer millennials also. The third set, which is what you spoke about, which is where there are individuals who are maybe in the late 30s or even in the early 30s and maybe late 20s, who ended up with that 5 to 15 crore category in a lot of the tech companies. That's the segment which we're not really targeting today, but we are hoping to kind of be ready for them over the next 12 odd months. So these are the 3 broad sub-segments. And the fourth one, which is really the segment which is maybe trading a bit between the 0 to 5 crores category, that's not something which we are kind of currently focused on in that sense.
Okay, if I can squeeze in a last question. So you spoke about the Accenture platform that you're building. So any update on that? And I also asked a related question to one of your colleagues in another platform. I'll just post it here again. So say take BlackRock, for example. They have their own platform and they started to build their own platform, and then they started selling it as a service to others. So are we thinking along those lines to build our own platform and then to sell that platform as a service to others?
Sorry, I'm not sure what exactly do you mean by sell your platform to others.
A wealth management platform where you can onboard clients who will then have their own set of
Okay. So as I said earlier, I think the Indian market itself is not large and mature enough for us to look at an external asset manager platform yet, which is what has become a global norm. I think as of now, we would prefer to deal with our ultra high net worth clients on a B2C basis, which means have a direct relationship with them. As the market was to become sizable and more mature, maybe after it's a strategy which we can look at after 5 years or maybe even 10 years. We're always open to that. But in the current context of things where our ability to reach a large set of clients continues to remain high, we are unlikely to launch an external asset manager platform.
Okay, on the Accenture platform that you're...
On the Accenture platform, I think, as we've kind of spoken about, we're moving into the implementation phase, and we will have multiple implementation partners. And it's not going to be a binary outcome after 12 to 18 months. We will have interim outcomes every 3 to 6 months. And we've taken out a budget of, as I indicated earlier, 5 to 7 crores a quarter for the implementation over the next 12 to 18 months.
Okay, thank you. That's it from my side.
Thank you. The last question coming in, we have from Nilesh Chetani. Kindly unmute yourself and ask your question.
Hi, this is Nilesh here from BOI Mutual Fund. My question was on the managed account front. So we were able to increase our AUM, say from FY20 levels from around 3,000, 4,000 crore odd levels to around 19,000 crores now. So wanted to understand, say 3-4 years before, say IIFL and the large distributors were the first port of call for large PMS and AIFs. So what has been the change in the market share of the total AIF distributed assets versus our share? Is the trend changing? Any outlook on this? Because that's one of the high yielding assets for us.
No, sorry, in that you'll have to just, from a market share perspective, you'll also have to add the managed accounts not earning a trail, because earlier it was reported under 2 categories, because pre-2019 we were taking it as an upfront. So the size of the pie for us was much larger, but it was coming in the line saying managed accounts received upfront earlier.
Okay, got it. So today, say at the recurring fees, whatever we report, 19,000 crores.
That will increase substantially, because earlier we were recording it as upfront. So the 17, 18, 19 managed accounts we were taking upfront fees, which is now got changed to trail. So therefore you're seeing earlier there were only, let's say 1,000, 1,500 crores of managed accounts where we are getting trail. Now that number is increasing steadily because of the fact that we moved it to the trail model.
So any growth outlook on this, where we see this piece going for next, say 3 to 5 years?
No, so I think it'll be an important part. So I think, everything which does not come on the advisory side of the business in the form of IIFL1 effectively remains on the distribution side. And part of the distribution ends up happening on the direct and part of it on the regular. And this really represents the regular part of the distribution business. So I would not believe it would, for any reason, grow lesser than the rest of the parts of the business.
Got it. Yeah, that was the only question I had.
Yeah. Thank you. Ladies and gentlemen, this brings us to the end of the conference call. Please feel free to reach out to our investor relations team in case you have any further queries. We look forward to your participation next quarter. Thank you once again.
Thank you, everybody. Thank you.
The recording has stopped.